the annuity puzzle. Welcome to Bloomberg On Demand, the business of life. I'm Carol Biaggi. Economists call it the annuity puzzle, the question of why most people don't buy annuities to help manage their money in retirement. It's an important issue as more Americans face life without pensions and may be unable to maintain their standard of living.
If I had to invent a product that was going to be the worst product to try and convince people to buy, it might be an annuity. And it's because annuities make perfect sense from an economic, rational perspective. But psychologically, they're just very hard to understand.
Columbia professor Eric Johnson says one problem is how annuities work. A buyer has to give an insurance company a large lump sum in exchange for smaller guaranteed payments for the rest of his life. That's an obstacle for people who suffer from loss aversion. The fact that losses feel more painful than gains are pleasurable. And present bias, a desire for rewards you can have now, not later. Brett Hammond is senior economist at TIAA-CREF, which sells annuities. He says the product addresses a key concern for retirees, longevity risk.
Longevity risk is the risk that you're going to run out of money before you die. Well, what an annuity does is that it can take care of longevity risk in that you get a guarantee from an insurance company that the money's never going to run out. You pool your money with that of other people, and the insurance company manages it so you get a check for the rest of your life.
The size of that check depends on what type of annuity you buy and other factors. The simplest kind is an immediate annuity that begins paying a fixed monthly amount immediately after you hand over the lump sum. The amount is based on current interest rates and your life expectancy.
The difference in the payouts.
Tom Koulis expects to live past 80. One reason he bought an immediate annuity when he retired in 2009. He paid about $153,000 and receives $823 a month, or about $700 after taxes. The annuity Tom bought addresses one objection to basic immediate annuities. When you die, the payments stop, meaning you can't leave the money to your heirs. So-called period certain annuities address the problem by guaranteeing payments for a set number of years. In Tom's case, it's a decade. His monthly checks are lower than they would be otherwise. He also chose a joint and survivor annuity that will keep paying his wife Kathy if he dies first.
Since she's younger than I am, I figured she'd probably live at least 30 years, and at that point in time, I would get we'd get almost double the money back that I put into the annuity. So I said, go for it.
Other objections to fixed immediate annuities include fixed payments don't keep up with inflation. You're locking in payments based on today's historically low interest rates. Once you've handed over your principal, you have limited or no access to it. That's one reason financial planner Bill Losey says people should limit how much of their portfolio, if any, they put in an annuity.
I think that they should limit the amount of the portfolio they annuitize to maybe 20 or 25% of their total investment portfolio, because once you give that portion of the portfolio to an insurance company and they annuitize it and start paying you an income stream, you've washed your hand of that capital. It's no longer yours, it's theirs. They have control of it.
Insurers are regulated by states, and the contracts are protected against default by each state's guarantee association up to varying amounts. Experts recommend checking an insurer's rating before buying an annuity from them.